Hello, and welcome to the Pricing for the Planet podcast, the podcast that explores the intersection of business and sustainability. Today, it's a special episode because we will talk about CFO and sustainability. So, Willem, thank you so much for spending those next 30 minutes with us. You know, we have a tradition in this podcast. We start from the end. So, Willem, what would be the key takeaway you would like the audience to remember from this episode?
Hi, Fabien. Well, thanks first of all for having me. It's a great honor, and it's a yeah, it's a great question to start with on the end, of course. And yeah, what I always tell the students in our executive courses is don't focus too much on the regulatory side of sustainability, but really see it as something very strategic where you have to take a dynamic perspective, a transition perspective, and put it into financial terms. So, not just the impact of sustainability issues on your finance, but also really these sustainability issues in value terms themselves. So, if you create or destroy value for society, try to quantify
It's music to my ears.
it.
So maybe for the audience, Willem, can you maybe introduce yourself first?
Sure. Yeah, I have two roles. I'm a professor of finance at Nyenrode Business University, which is a Dutch business school catering mostly to in executive education. And my other role is as head of sustainability client advisory at Schroders, which is a UK asset manager, where I mainly advise pension funds on investing more sustainably. And again, making the point that by putting it in value terms, they can make it comparable to their financial results and really see the trade-offs involved.
Perfect. And you know, at Pricing for the Planet, we have a big belief. We believe that we can monetize sustainability. What's your point of view on this one?
Well, that's a point where we clearly agree. So that was also why I was so happy that you invited me, that you exist in the first place, because I think that's key. I mean, effectively, what we've seen over the past decades, this whole trend towards shareholder value focus, too often it has meant that effectively sustainability was put at zero value when it wasn't priced. And yeah, the Friedman argument of the business of business is business. In theory, it's valid if government prices everything in, but of course, in practice, it's not. And that means we're now on a path to basically destroy our living environment. That's the bad news. The good news is, I think there's clearly a way out for capitalism, namely to put a lot more value on these environmental and social issues. And that's not just a role for governments. It's definitely also a goal for business, because they can create value and show that value. And yeah, monetization is a perfect way to do that. And of course, monetization can mean two things. One is showing the value as a shadow price that you don't actually get paid for. The second is actually getting paid for it. And of course, then win-win situation would be where you partly get paid for it, so that there's some consumer surplus left for the client, but at least showing the extra value that you provide, and then letting them pay for it, as far as it also results in higher cost. Yeah, that's fair, and it brings accountability, brings better decisions. So I'm all for that.
Perfect. And can you maybe explain a little bit more what you are doing with CFO? Because I think you have quite a unique approach working with sustainability and with the CFO community.
Yeah, no, definitely. I'd better go back a bit in time then to where I'm coming from. So I'm by origin an investor. So I I've been a valuation consultant, but then and after my PhD, I joined Robeco as an equity analyst, and then I became an impact equities portfolio manager. So I got interested in sustainability about 15 years ago. And what struck me then was that I was covering the materials sector. So that's basic resources, chemicals, mining, etc. And it struck me that mining companies were losing billions on non-managing projects very well, where they lost sight of stakeholders. Whereas some chemicals companies were making a lot of money on providing solutions. So that got me thinking, and to link it to valuation was necessary in our investment process, because we could only invest in companies that were worth more in our model than on the market. So we just made the connection, and the connection was the business model. So it was a simple three-step approach. First, is this company, what are the material issues here? Second, does it have a competitive edge, yes or no? And third, what does it mean for the value drivers? So does it get higher, lower growth, margins, cost of capital, capex, those kind of things. And that got me going. So, and that was just single materiality. Then over time, we got into double materiality. So also explicitly quantifying the ENS, the environmental and social, as values in themselves. So in 2016, I started writing a book called Principles of Sustainable Finance, which we published in 2019, which was well received. But people, and especially students, said, where are the numbers? Where are the calculations? So right after finishing that one, we started writing a new book, which we published last year, and it's called Corporate Finance for Long-Term Value. And basically what we do there is that we do everything that a typical corporate finance book does. So DCFs, the investment decision rules, M&A, option pricing, capital structure, cost of capital, all the typical finance topics. But we first do it in the traditional way of what does it mean for the financial value? Then we take into account how the ENS might affect all these decisions. And third, we also calculate them including this other type of value, which we call integrated value. And so the book offers a lot of clues to what CFOs can do. But it's 650 pages, which is quite a lot for CFOs. And I met actually two CFOs who read the entire book. But even they said, well, could you please publish a 200-page version, and then I can give it to my finance team. So that's our assignment basically now, is to make it very practical for people to apply, because the decision rules in a listed company are different from those in a partial state company or an infrastructure company or what have you. So basically, I after we finished the book and we presented it, I made this call to CFOs asking, hey, who wants to steer on broader value than just financial value? Please get in touch with me and let's see how it works. And it's great because I get a whole range of CFOs, also listed ones. And of course, the bias is that listed companies only steer on shareholder value, and especially with lots of American companies, that's true. Just look at Boeing, what happened there. But there's definitely also listed companies who have shareholder value as a goal, but also other goals, like a climate goal, which is very hard as well. So they have to balance these two goals. So I simply give them stylistic investment opportunities. So 12 investment projects, positive and negative MPVs, positive and negative E or S value, add it up. And then how do you choose? And we then show that it's possible and it's rational to choose sometimes investment projects with a negative MPV, so negative profitability effectively, but which are so strong on the E and the S that they help you achieve other goals.
Interesting.
And then to make the link to pricing, another thing that is useful for them is simply to make a list of these projects in terms of how much social or environmental value you get for the investment that you make, or for the potential return that you give up. And then, because it flows from two questions I basically get from these CFOs. So one of them is, how do I evaluate my investment decisions, not just on financial value, but on broader value? And the other one is, how do I get a better pipeline? And the better pipeline means that their subordinates or the business units, they have to think in the same way and they have to see the trade-offs as well. So it's not just about filling in right numbers, but also really doing the thinking and go back to the drawing table and try to change the project in a way where you get better value in all respects. And that's a key issue for them. So it's a mindset change. And these CFOs, and sometimes they call themselves CVOs, they don't complain about data like most people do. They're confident that the data are there. It's just about asking the right questions. The hard part is really more about what do you want to achieve, and then think about what kind of KPIs, data, etc. you need. And the other challenges are indeed setting the right decision model and getting people involved in inspiring them, basically. That's all of that is harder and more important than the data. The data are just a means.
Yeah, no, absolutely. No, it's fascinating. And do you have by any chance maybe an example to really illustrate, what it looked like to make it
Sure.
concrete, maybe?
Yeah. No. Let me give you a single materiality example first. So, what does it mean for a stock listed company? As a stock listed company might have an asset that is oil based, and it wants to convert it to a renewable asset. So it's being analyzed within the company, and then the controller says, "Well, we have to make an investment in the conversion, so that's a negative cash flow, and afterwards the margins are also lower, so it's a vastly negative NPV decision." However, the CFO said, "No, you got it all wrong. This is a stranded asset. So if you keep it as an oil asset, margins will go down, and you lose the terminal value. So in fact, in spite of the lower margins and the investment required, the conversion is actually a positive NPV decision. So it's a different way of looking at it. This is the cost of inaction, typically quantifying it. If you go for double materiality, well, a lady at a network company, she was a business controller sustainability. I had never heard of the function, but it's perfect, because what this lady was doing, she was basically a broker in information across departments. So trying to get information across all kinds of departments on their sustainability goals, what kind of projects could be done to achieve them, how much would they cost, how much would they achieve in the social and environmental value, and then data assessments of the likelihood of getting this done, how many external parties would be involved. But it's making it so tangible that you can really make choices,
Yeah.
and that's the key.
No, for sure. But to come back on your first example, I think we still have a lot of work to do, even on the, like on the single materiality point of view.
Absolutely. Yeah.
We are so far away, and we still have people coming, to discuss with us at Pricing for the Planet. And when we talk about, what is the cost of capital, what will be the impact of, not doing anything, or even if you start deep diving on the cost of polluting, that you don't see it, but when you start deep diving, the cost of polluting is there, but it's just, like buried behind a bunch of, like, it's the normal way we've always done that, so we
Yeah.
don't challenge that. So I think, even, without going into the double materiality, which is great to go in this path, but just by doing, business as usual with financial, weapons, kind of,
Yeah.
we still have a lot to uncover.
Absolutely. Although doing the double materiality analysis is even useful if you're not that advanced on the single materiality side, because the double materiality gives another perspective on single materiality as well. So, I mean, we did this case study on Inditex in the book, and Inditex at the time had a market valuation of 80 billion. But we separately estimated their positive social value, negative social value, and negative environmental value, and each of those was bigger than their financial value, which goes to show that these have huge risks. But also, in total, the firm value was positive. So an NGO might say, well, this is a bad company, they have to go bankrupt, out of business. No, we say they have to find a transition path where they can keep the value creation, but get rid of the value destruction. And to put it another way, the Canadian pension fund board member put it really nicely. He said, all these companies with negative externality, so with negative value in there on the E or the S, it's like having options written against me. That's what he said. So in that sense, and that brings me back to the book, we try to quantify that. Having these negative externalities effectively reduces your financial value as well. I mean, it drives up your cost of capital. It has this option value. You can calculate in many different ways, and of course, it's quite imprecise yet. But we apply the same logic. So the typical. Now I'm getting very technical for a moment, but people who did a corporate finance course will know the Modigliani-Miller theorems, saying that having more leverage doesn't change the value of the firm, but it does raise the cost of equity. Well, according to the same logic, having more negative externalities also raises your cost of capital. And just knowing that and accepting that makes people more aware of these kind of issues.
Do you see a future where bad company in ESG won't have access to capital at all?
That might happen. This cost of capital is not just theoretical; it's already happening. So brown companies are already paying a slightly higher cost of capital. And for example, cement companies a couple of years ago were already complaining that they found it really hard to get capital, but more because of ESG ratings than anything else. And there's some perverse effects in there as well, that if all these investors start excluding these companies, then they're going to be sold to people who don't care at all. Yeah. So it's much better to have committed shareholders and then help these companies transition.
And that's super interesting, because I think we are kind of like in a almost like a teenager mode where, it's good or bad. It's you're bad at ESG, you are good at ESG, and then, when you listen to some activists, it's like, okay, bad ESG, they should not exist. Well, I mean, good luck telling,
Yeah, exactly. I mean, some companies are evil in the sense of but it's a tiny minority. The vast majority, they want to do good things, but they're partly forced by the system to play according to the rules. So yeah, what then the logic is not to condemn them. No, it's help change the system, change the rules a bit, and help them navigate these kind of transformations, build new business models where they are able to create more value. But then it's very important for them to see what their value creation profile looks like, and how they can get to a value creation profile where they are positive on all capitals. I mean, people feel more comfortable just maximizing one thing. I know that. But if you go to the doctor, he or she will also not just judge your judgment based on your temperature, but look at lots of different angles. And it's the same with company health. I mean, you have to be healthy across all dimensions. being unhealthy on one of them can already kill you.
Absolutely. And we talked about integrated valuation. Do you integrate as well the concept of true pricing? Is it something you explore?
Yeah, definitely. No, we used true pricing to estimate the ENS values actually. So, I mean, the simplest example is, of course, CO2. So, for example, for Inditex, they had about 20 million tons of CO2, and at a price of a shadow price of 200 euros per ton, that gets you to 4 billion in negative value flows per year. Well, you can discount that, and then you have the negative value of their carbon footprint. And similarly, you can do that for other aspects on the social and environmental side. But in the end, we had to take shortcuts simply for lack of data. So, for example, True Price, the sister organization of Impact Institute, they did a true pricing of a jeans where they found that the typical jeans of 80 euros has a hidden cost of 33 euros, of which 11 euros on the environmental side and 22 euros on the social side. Well, you can extrapolate that and in that sense, make an estimate of the true costs of garments in general. And then we gave them the benefit of the doubt and still got huge numbers. But
Yeah.
given the current state of reporting, yes, you have the CO2, but all the other data, you don't have the units where you can put a price on yet, or in most cases. So you have to use external assessments from academics, sometimes NGOs or competitors, then apply a price to it, and then you have the value flows that they create on that. It's perfectly doable, but you have to make the leap of looking for the information that you need instead of just accepting what they happen to put in the annual report.
No, absolutely. So it's super interesting. And again, and one of my key takeaway from our discussion is we see too many people willing to go towards sustainability, forgetting about the CFO, while the CFO is a very strong supporter of this kind of move.
Yeah, yeah, it should be. I mean, the CFO is ideally positioned to be the plumber of all this. I mean,
Yeah.
the kind of information flows that he or she normally manages on the financial side, you can do that on the ENS as well. Um, and of course, you don't need to report all of that. It's much more important to have the data internally and know your own value creation profile. Ideally, know that of the competition as well, because then you can find out to what extent you can what you can price and what not. Because it's not just about the absolute value creation profile; it's also relative. So, for example, in aluminium, if you are an aluminium producer based on gas, then yes, sure, you have a high carbon footprint, but not as high as aluminium producers on coal or your steel competitors. So you have a very high footprint, but if the carbon price goes up, you actually win
Yeah.
because your costs go up less than those of the peers, and you will have a boon to your sales and margins. So it's also having these relative plays, the dynamics of competitive positions. That's what you have to be looking at as a CFO.
And you mentioned, ICP with shadow pricing before.
Yeah.
Do you see a world where, ICP will be, an obligation or something that, the governments will, look at?
You mean at companies having an internal carbon price?
Correct.
Yeah. No, it's. Um, I think it's going to be a matter of credibility.
Mm.
So I recently met a company that in a very carbon intense industry that has an internal carbon price of 200 euros.
Okay.
And there was a lot of resistance internally, but it also made them a lot more creative on finding new projects. And what they hope for is that having this kind of carbon price in place and also doing the work on biodiversity and human rights will allow them to offer projects that are superior and that might be somewhat more expensive than that of the competition, but will offer a lot more value to their clients, also because the end clients will value that more. But they're also aware that they will have to step up their game to actually show the extra value. And we see it in also locally in the construction sector where construction companies building for local governments say, hey, we want to get more clarity on getting paid more for a project that deliver more value. So it's clearly a discussion, and then having a high carbon price is a great step. But it's a moving target, I would assume.
For sure. Super interesting. Willem, we are running out of time. So,
Yeah.
where the audience can find out more about what you are doing, how can they follow your great work?
Well, if the best thing to do is just follow me on LinkedIn and look up our book. It's called Corporate Finance for Long-Term Value. And as I said, it's 650 pages. However, if they read chapter 2, which is 30 pages, they'll get an excellent summary of what it means and why these shadow prices are essential in building better strategy and connecting sustainability strategy and finance. So for the CFO of the future, totally recommend reading it. And feel free to contact me by mail or so. So I'm already hoping to have a chat with one of your former guests on this topic, but hopefully more to come.
Perfect. Willem, again, a huge thank you. Thank you so much for the audience. If you want to continue the learning journey with us, you know the drill. It's www.pricingfortheplanet.com. We have a bi-weekly digest. It's a newsletter. We have our podcast. We have our events. So feel free to continue to learn with us and join the movement. A huge thank you for your time and for your commitment.
Great to be here. Thanks.